Friends, I'm Pradeep, founder of Justice Strength. Past couple of days, we have been hearing this across all medias as well as in newspaper articles that its Fed has dialed back its bond purchase program. What does it mean by this bond purchase? Quantitative easing, tapering. Is it that technically highly sophisticated terms that a layman cannot even understand those? In today's video, let's try to unwind those jargons in a layman's language and let's understand what is the motive of Federal Reserve by doing all these activities. Let's get started. Federal Reserve, which is a central bank of US, which is also known as lender of last resort, has got two main objectives. One is maximize the employment in the economy and to have the price stability. To achieve this target, Federal Reserve has multiple tools at its disposal. They would be doing money market operations as well as balancing the interest rates. But in case of emergencies, like one we had way back in 2007-8, the housing market collapse, and the one we had recently in March 20, coronavirus outbreak, in those situations, the economy was in deep trouble. It was in under depression. In those situations, the Federal Reserve has two tools at its disposal, which they can use only during the case of emergencies. One of the tools is quantitative easing, the another one is negative interest rate. Fed technically has never used the second tool, that is negative interest rate, since its inception, from its date of its establishment till now. It has never used this negative interest rate. Even though few countries like Japan in other part of the world, they have used this negative interest rate mechanism to stabilize their economy, but the Fed till now has done this quantitative easing alone. So what is this quantitative easing? As we all know, the bonds is an instrument which has coupon on it, that is the holder of the bond would get at the time of maturity the principal along with its interest. So in this case, the Federal Reserve is the holder of the bond. They will be purchasing the bonds from the market. In doing so, they will be releasing the money, fresh money into the economy in the hands of the governments and private agencies. So why they have to do this? Due to this downturn in the economy due to coronavirus outbreak and way back in 2007-8 due to financial crisis, no one was motivated enough to start up their own business or even to go to a job or to buy a home, car or to do a luxury spendings. No one is that motivated, right? Even in March 20, we were satisfied that we are just alive. So to do all this stuff, Federal Reserve as well as the government, they have to take some efforts. So this is one of the efforts that they are going to take. So in this bonds, there are two sets of bonds. One is treasury bills, as I said before, another one is mortgage-backed securities. Treasury bills, where the governments, they would be getting the money by selling these bonds to the Federal Reserve, would be using this to do a direct benefit transfer, to settle the claim of the unemployed persons, and as well as to do other socio-economic activities. And the agency mortgage-backed security, here is the catch. Here the private agencies, they are directly borrowing the money from the Federal Reserve to scale up their business, to generate employment, and to even to increase their profit positions. Just understand this one aspect. Interest is the cost of holding the money. Money in itself is a good. To hold that money, you have to pay something called interest, right? So if the money supply in the economy is high, when the supply is high, the interest rate would low, and vice versa. When the money supply in the economy comes down, the interest rate would increases. It's normal demand supply issue. After coronavirus outbreak, Federal Reserve has announced that they would be doing this quantitative easing program, that is they would be aggressively buying these bonds outright from the market. Since March 2020, they have been doing this activity in two sets of bond. One is treasury bills, where they have been buying $80 billion worth of bonds on a monthly basis from March 20, and then 40 billion worth of mortgage-backed agency securities worth rupees $40 billion. So 80 billion, if we translate in INR, it comes around 6 lakh crore rupees, and 40 billion, if we translate in INR, it comes around 3 lakh crore rupees. So this is the amount of fresh money that's entering the economy since March 20 on a monthly basis. Just take a look at this Federal Reserve balance sheet size. If we see in 2008, it was around $1 trillion. That is the entire assets of the Federal Reserve, which would be in the form of bonds, right? That has slowly, it has scaled up from 1 trillion to 2 trillion, right? In just a matter of 1 year. That is after this 2007-8 financial crisis. Even at that point, the Federal Reserve has used this mechanism. So the bonds size in their balance sheet has risen, right? If you see the graph, there are three layers. One is blue, which is T-bills, and yellow is the mortgage-backed security, and the gray portion is the other instruments. That also goes directly to the private agencies. That is, beneficiary of those bonds would be the private parties. And then slowly the pace was increasing from 2009 to 2014, and it was stabilized. The asset didn't increase much thereafter. It was stabilizing, it was consolidating. See, so no new bonds was purchased by Federal Reserve thereafter. Again, if you see in 2020, it was around $4 trillion. Suddenly it was risen to $7-8 trillion. So doing this, what happens is that the money flow in the economy would increase, the interest rate would come down, most people will be incentivized to do the business at the lower cost of borrowing, and there would be much generation of employment. Quantitative easing, in total, it has three processes. One is called as expansionary, another one is tapering, and then tightening. So the expansionary is the stage what we are experiencing currently. That is, the bonds that Federal Reserve is buying is known as expansionary portion. That is, they are expanding the money supply in the economy. So the GDP growth, inflation, everything would be at its peak. So as I said, when the money supply in the economy is high, obviously interest rate would be low, because the more money is chasing lower set of goods and services, and more money is chasing few businesses, and businesses would be demanding for the lower interest rate, as already their businesses was dented due to COVID. So the interest rate is low, and inflation would be at its peak. And then currently what the Fed has announced is the tapering. Tapering has technically, it has begun in November 2021 itself. In tapering, what happens is that the Federal Reserve would still keep buying the bonds, but not at the same pace that they were doing previously. They have reduced the pace of buying. That is, the worth of bonds that they will be buying. They have slowed down that process. Doing so, the inflation would come to the normal state, as well as the interest rate would moderately would come down, and the stagflation, that is, the inflation is there, but the goods and services is not increasing the economy. That position would be slowed down due to this activity. Tightening, this is most frightening issues. As we saw in previous chart, that is, the balance sheet was only on upper trend. In case if they want to downsize their balance sheet, that is, what they would do is they would come to the market outright, and they would be selling those bonds through open market operation. That is really frightening. That would cause the money supply pull off from the economy very suddenly. That would really diminish the economic movement. By doing this tightening, as I said, the money supply would come out of the economy, and the total money in the economy would come down, and obviously interest rate would go high accordingly, and inflation would be at its low. So technically, if you see, as I said, the November 2021 onwards, the tapering has begun. That is, from March 20 till October 2021, the total value of bond purchases on a monthly basis by Federal Reserve was $120 billion. In November 21 alone, they have reduced from 120 to 105. In December 21, from 105 to 90 billion. Now from January onwards, in the recent meeting that was held on December 15, the FOMC, that is Federal Open Market Committee, has announced that going forward from January onwards, the bond purchases in the market would be reduced to $60 billion. So this is what they have announced. This is what everyone are speaking about, the bond dialing back the bond purchases. It is not meant that they would be selling back the bonds. It is just they would be slowly reducing the pace at which they would be supplying the extra money in the market. How this quantitative easing would be put to rest? There are two ways that this balance sheet size would be reduced. One is by allowing the bonds to mature. That is, the Federal Reserve, they are currently sitting on some bonds, so they have to allow this bond to mature. They would be collecting back the money along with the interest, and they would be offloading this treasury bills from their balance sheet. This is smooth and slow process. This won't affect the economy very sooner. This one would have a very staggered effect on the economy. The second one is most frightening. This is one I would call as a bad ending. This one, the Federal Reserve has never done in its past, and now there was a talk is going on, this has to be done. So this is what is called as selling the bonds outright through open market operations. In this case, what happens is the bonds, that is the asset of the Federal Reserve, they would be selling to the commercial banks, and they would be offloading this bonds, and so that they would be pulling out the money in the economic system, and obviously interest rate also will go high. This one would really dent the market sentiment. Okay, so even in newspaper we saw that recent market correction was attributed to this tapering. Why is it so? why it has happened. So let's correlate this with the situation that we had back in 2007-8. In that scenario, when the economy was in a slow pace, when the Federal Reserve has started to do this bond purchases from $1 trillion to $2 trillion between 2008 and 9, the stock market has also recovered by 72%. And thereafter, it was consolidating, but still it was in an upward trajectory. It has never come down. Between 2014 to 20, I would say it was like a kind of a consolidation with upward trajectory. That is, after this 2020, the market took a nosedive. Thereafter, the market has recovered like 100%. That is, the bonds also was moving the same pace. At the same pace, the market also has recovered so high. Due to this tapering, still the asset positions of the Federal Reserve would be at the stable pace. That is, the asset position, it won't come down, but still the market has been reacting to this as a bad news. So if the Federal Reserve is planning to do a tapering, that is, if they slow down the asset purchase, accordingly the money supply in the economy would come down. The corporates would struggle to report good profits as they have been doing in the past couple of years. That's why the market is seeing this as a bad news. Let's take a look at this FINDI data. Even in India, we saw that there was a late correction after October 20 run-up. That's very obvious. November 21 onwards, the Federal Reserve has started to do tapering, and FII, they are smart people, so they have started to pull out the money from Indian economy. So from May, if you see, there have been net sellers, right? On the left-hand side, you can see the FIIs, the net purchase or sale position in the Indian market. The right side, you can see the DIS positions. The FIIs they have been selling like around 60-70,000 crores. DIs are supporting the market through this. Why it is all happening? It is because of retail investors. We are the one who are supporting the market at this level. Due to some bad influences from the social media as well as from few YouTubers, retail investors are deceived and they think that even just like 5-10% correction would be the right point of entry. Why is it happening? This is what we call it as a FOMO in the market, that is fear of missing out. Already the market has rallied by 100% after March 20 correction. Most of the investors, they felt that they were not given the opportunity to participate in this rally, so they think that even like 5% correction would be the point of entry so that they can participate in the upward movement from here. And then other side, that I could call it as a snowball effect. That is, in this case, what happens is just 5-10% crash is enough. Then what happens is those who are sitting with huge amount of profits, they would be afraid that the market would come down even further, and they would be start booking the profits, and everyone would be start selling the thing. So both this FOMO effect and snowball effect has a effect over the market in a near term, but still on a long term, if you see, the market is always market will always reflect the economic condition in the long term. So at this given point, I would advise the retail investor to avoid buying on dips. Avoid high-levered companies and loss-making companies, since the tapering thing has been started, and then slowly the tantrum would also start. That is, the interest rate would also go high. So according to those who are sitting with high borrowings, they have to pay higher cost on their borrowings so that their profits would get affected. And loss-making companies, obviously, they are steeply into losses even during this expansionary stage. If they definitely can't face the contractionary stage, right? So I would say this would be the right time for few people to book few profits and enjoy before the FIIs can enjoy everything.